Hi, I'm Bill Burke, the Managing Director for Ground Rush Financial, and these videos are a way to share ideas and sales strategies with you to share with your clients and just give you some ideas on how to explain scenarios and how to just become interesting to your potential prospects. Now, today we're going to talk about sequential returns and the yellow box. Now, let's talk about the yellow box. As you look on this chart, you know that the yellow box is when retirement starts, and prior to the yellow box, you have all this volatility in the market. Now, the volatility is great when you're not pulling money out. The yellow box represents the beginning of sequential returns. So what we've learned so far is that we get past the yellow box, and the next chart was simply saying we're now going to talk about what the yellow box means in terms of an indexed annuity. So let's take a look at this. The average market gain prior to our yellow box here was 7%, 7.05%. And we didn't take any money out. And the indexed return was 5.62%. So during the growth period, the stocks and bonds and S&P look great. Now we get to the yellow box. And per John Bogle, the Vanguard founder, who said, retirement's a lottery. You either are lucky in retiring in a good market or you're unlucky in retiring in a bad market. Now, this is what I'm going to get into here. When you look at this yellow box, you're going to notice that the volatility exists, and that 5.62% on the index probably looks pretty good compared to losing 20 or 30%. So this volatility still goes on. But what I'm going to mention now and go into is what does a portfolio look like? And this is where it came in last week of talking to somebody who had a Schwab portfolio. Now, I never saw what that portfolio was, but I've seen enough portfolios to know what volatility means. And I'm going to show you a tool now that we use. So think about this. We've got our yellow box, and now I'm going to show you a score, something called the NASDAQ QQQ. This is the measurement of the NASDAQ, and as you know, the NASDAQ is where most people are putting their money. That's what it's going to duplicate. So our clients are not matching the S&P. If they're in stocks, they're usually in a NASDAQ type of portfolio. Now here's what these charts all look the same, but I want to explain this first one on the NASDAQ. It's a 78 risk score. The risk score means 100 is the max. If you score yourself, my risk score is about a 25. If my risk score is a 25 and I have an investment that scores a 78, it means I'm exceeding my speed limit. When you exceed a speed limit, consequences are going to be very bad. Now let's understand what that means. If I look at this NASDAQ, the 1 year return, negative 18. That's where the 3, 5, and 10 year. But look at the 3 year average, 11%, 5 year, 12, 10 year, 17%. Now that fits with what people have done in the market. I want you to now look down to the left, the blue line. You'll notice that during the accumulation period, there was growth and significant growth until the last several years. But now look at the yellow box. This is when you retire, and you're going to see on max drawdowns of 26, 32, 81%. So my question is this: if you retire and your portfolio operates like the NASDAQ, I think if you know sequence of returns, that's going to be a problem. Because I wouldn't want to suddenly have a 32% drop in my retirement portfolio and still have to pull out income. So that's very important. And this is the kind of material I can do because I go through a portfolio and I simply measure whatever stock you have. I can measure this, and it becomes sort of a shock to a lot of people because people have no idea of what volatility means. Now here's Tesla. Now this is a very interesting. With Tesla, okay, 1 year return, negative 44%. But guess why everyone got crazy over Tesla? The 3 year average growth on Tesla was 58%. 5 year growth, 48%. 10 year growth, 52%. Look at the chart on the left, the graphic, tremendous growth. But look at your yellow box. That again, people who get into it, you can have some stock in retirement, have Tesla, but to have a portfolio overweighted at a score of 100, by the way, this is the max score, I know people were excited about Tesla stock a year and a half ago. Lately, Tesla stock has been in the dumps, and it's very volatile. So again, why would you want to have that as your master part of your portfolio? There's Salesforce. Again, similar results. 5-year 8%, 10-year 14%. But look at the yellow box again. Lots of volatility. And it was a score of 100. And now I'm going to take Hewlett-Packard, our famous legacy company here in the Bay Area. Its score is 100. And look at its returns. 3-year 8%, 5-year 2.98%. The volatility is evident on the left-hand side, but look at the yellow box. Again, my point of this story is when you're looking at a portfolio, people really don't know what their portfolio is. And this can be in mutual funds or it can be in Fidelity. No matter what, people really are not aware of, number one, the sequence of returns, and number two, they don't know the stocks that they own, what they look like in terms of volatility going forward. So this is a very important concept that can help you going forward.